All right, Tesla's new quarterly numbers just dropped, and honestly, they tell a pretty fascinating story. On one hand, you see these record-breaking sales, but if you look a little closer, there's this huge strategic shift happening that is really all about the company's future. So let's peel back the layers and see what's really going on behind the numbers.
Okay, before we dive in, we've got to do the usual housekeeping. Just a quick reminder that everything we're about to talk about is for informational purposes only. We're here to break down the report, not to give out any kind of investment advice.
Here's how we're going to break it all down. First, we'll hit the big financial picture. Then we'll zoom in on the heart of the company, the car business. After that, we're going to look at their huge bets on energy and AI. And finally, we'll piece it all together to see what Tesla's roadmap for the future actually looks like.
So let's get right into it with the Q3 financial snapshot. And really, a quarter of contrasts is the perfect way to describe it. It was this wild mix of incredible, record-setting growth in some places and some pretty serious pressure in others.
First up, total revenue. It hit a staggering $28.1 billion this quarter. That is an absolute record for them, and it just goes to show you the sheer scale of their operation. But, and this is a big but, that top-line number is really only half the story.
Okay, so here's where things start to get interesting. Their operating income was $1.6 billion. Now, that's still a ton of money, of course, but it's the trend behind this number that's so important here. We'll circle back to that in just a sec, because first, there's another major positive to look at.
And that positive is free cash flow. Nearly $4 billion of it, which is another record. This is the cash the company has left after paying all the bills and making all its investments. Think of it like a huge war chest that lets them fund all these massive future projects without having to borrow money.
So check this out. This table really lays out the core puzzle of the quarter perfectly. You see, total revenue up 12%, and free cash flow is up a whopping 46% compared to last year. That sounds amazing, right? But then look at the other side. Operating income, down 40%. And operating margin, which is just how much profit they're making on every dollar of sales, it dropped by 5%. So the big takeaway is this. Tesla is definitely growing, but it's getting less profitable for now.
So the big question is, why are profits getting squeezed? Well, it all leads right back to their core business, the engine of the whole company, automotive. And this is where that whole story of more cars but tighter margins really comes to life. I mean, you just can't argue with the volume. Tesla delivered almost 500,000 cars in just 3 months. That is another all-time record. It shows that even with all the competition and economic jitters out there, people still really want these cars.
And this chart, this shows a really key detail about how they're operating. Look, they actually delivered about 50,000 more cars than they even built this quarter. And what that means is they're just burning through their existing inventory like crazy. And that leads us to this metric they call days of supply. It fell to just 10 days. Now, to give you some context, a lot of the traditional car companies might have 60, 70, even 90 days worth of cars just sitting on lots. 10 days? That's insane. It means cars are basically being sold the second they're ready.
So, how are they pulling off this incredible volume? Well, a huge piece of the puzzle is price. By launching these more affordable standard range versions of the Model 3 and Model Y, Tesla's opening the doors to a much wider group of customers. This is a massive reason they're hitting those record delivery numbers.
Okay, so if the core car business is selling a ton, but profits are getting tighter, where's the future growth going to come from? Well, this is where Tesla is making its really big bets. Energy and AI. This is their vision for tomorrow.
Whoa, just look at that number. The energy division is on fire. Their energy storage deployments, that's things like Megapacks and Powerwalls, grew by a massive 81% compared to last year. This isn't just some side business anymore, it is scaling up incredibly fast.
And they're not just sitting back. They're pouring fuel on that fire with new products like the Mega Block. You can think of it like a giant pre-built Lego set of batteries for utility companies, designed to make building huge energy projects way cheaper and faster.
Now, this quote from their shareholder letter, this is everything. It shows you exactly how they think. They don't just see cars and batteries as hardware, they see them as the foundation for a future that's completely driven by AI and software.
And it's not just talk either. They're making real, tangible moves. In this quarter alone, a new version of full self-driving started rolling out. They actually launched a Robotaxi service in the Bay Area, and you could even sign up for the app waitlist. Plus, they seriously beefed up their AI supercomputing power. These are concrete steps, not just promises.
Okay, so we've seen the present. A core business facing some margin pressure and these new ventures that are just starting to scale up. So what does the road ahead actually look like for Tesla? Well, in their own words, it's all about navigating the short-term bumps while building for the long term.
This slide right here, this nails their whole strategic shift in a nutshell. Today, the focus is on making the hardware, the cars, cheaper and more efficiently to squeeze out a profit. But tomorrow, they are betting the entire farm on profits from high-margin software, AI, and other services that run on top of all that hardware. That's the pivot.
And they've actually put some dates out there. They're pointing to 2026 as a massive year. That's when they're targeting volume production for the Cybercab, the Tesla Semi, and the new Megapack 3. So, these are the huge milestones to keep an eye on over the next couple of years.
And this final quote just brings everything full circle. It's the answer to that puzzle we started with. Why are sales up but margins down? Well, they're willing to take a hit on hardware profits today because they believe the real prize is the explosion of AI, software, and fleet profits that they plan to unlock tomorrow.
Which leaves us with the big, multi-billion-dollar question, right? With profits on the actual cars getting tighter and tighter, can these huge, ambitious bets on software and AI actually deliver the future that they're promising? That right there is the story to watch.